I'm Dan Phelan, President and CEO of Pacific Southwest Realty Services here in San Diego, a commercial mortgage banking firm. To my immediate left, Wayne Brander, Executive Vice President, U.S. Bank. To his left is Tom Nolan, Managing Director, Chief Credit Officer with CW Capital. And to my far left is Kevin Donahue, Senior Vice President, Midland Loan Services. Starting off here, I'd like each of you to kind of just tell us what you do with your company, your position, your company, what you head up, and what keeps you up at night and your companies as far as looking to the future. Wayne?
Okay, I manage the production offices in California. We have 5 production offices. So I really oversee the new production and work closely with our workout teams when a loan moves from our side of the house into their side. Regards to what keeps me up at night, really 2 things. One is Washington and their view of the banks, and they've taken a very active role in guiding the banks through a very difficult process. The level of scrutiny and examination of the banks have only increased this year. It's not going away. And the net result is they will be guiding the banks to dispose of assets. And you'll see more of that this year. The second element is really what I'll call the cart in front of the horse. And that cart is the bags and bags of cash represented by capital, and the horse being the economy and the jobs. And there are a lot of people betting on that horse, but that horse is still in a stall. And when the question is it going to run, when is it going to run, and how fast it's going to run?
Okay, Tom?
Typically, we've got a pretty clean balance sheet, but the things that kind of keep me thinking at night and our company thinking at night is our DUS operation has grown significantly over the last couple of years, so we're certainly kind of watching the credit in that portfolio to make sure that we keep originating good, solid loans. Our history in the DUS program has been excellent as from a loss standpoint, and we want to make sure that stays where it is. I also chair our special servicing credit committees, and CW Capital is the second largest special servicer of CMBS product in the country. And while we have a lot of positions, those control positions are in the non-rated single B, double B range, and as losses hit, we start to run through those positions, and we could lose control positions in some of these bonds. So we're constantly looking at that risk and looking for opportunities either to talk with senior bondholders or to acquire some positions to kind of insulate our future.
Yeah, I'm with Midland Loan Services, which is a division of PNC Bank N.A. Midland is one of the largest third-party commercial mortgage servicers in the country. I run the special servicing and real estate solutions operations. So, that's been a growth business, and in terms of what keeps me up at night, I've sort of lost track. I haven't really slept since the second quarter of '08. So, but I think that, I think like everyone else, what keeps me up, actually I disagree with Wayne, Washington is sort of what puts me to sleep, but what keeps me up is just sort of the fragile recovery we're seeing. We see positive signs in certain markets, not so positive in other markets. There's a real dichotomy out there between what's doing well and what's not. And then you sort of look at it in the context of macroeconomic issues, what's played out across the front pages of the last few months in the Middle East, and with oil prices and with the debt crisis and the shutdown in Wisconsin. Those are the things that I really am concerned about, just because it has such a great impact on the recovery in commercial real estate.
Kevin, as we have been working through the various defaults that have occurred since 2007, are we getting into kind of the workout 2.0 today, different from maybe where we were in 2008?
It's a little bit different, and part of it is just that the market has stabilized to a point. People are a little more comfortable with where the markets are and where they think they may be going. I think there was a lot of discussion in '08 and '09 about this bid-ask spread that was so wide. I think that has narrowed somewhat. I think investors have gotten a little more realistic about their return expectations. I think they've accepted the fact that assets are not going to be delivered to the market on a wholesale basis, distressed assets that is, either through CMBS special servicers or through the banks. So I think what's different now and what we're seeing in our shop, and I think Tom sees the same thing, there's a lot of capital, pricing has improved. There's a lot of ways to restructure around problems, not the extend and pretend you talk about, but actual restructures that make sense, that attracts fresh capital to improve the quality of that asset. So I think from that standpoint, the liquidity, the fact that the debt markets are coming back, CMBS, new issuance is returning. I think all of those things make the workout landscape a little different now than it was, even 12, 18 months ago.
Now, I would tend to agree with what Kevin's saying. The other thing that I would add is I think the borrowers in these workout situations are now starting to see a stabilizing of the properties. Hopefully the drop in value is kind of stopped or at bottom, and there's an opportunity for those properties to rise. So based on that, they're more willing to inject some fresh equity into some of these properties if the lender is willing, to kind of bifurcate the loan or take a write down on the loan to a reasonable level. I think the other thing is that borrowers have figured out, at least in CMBS land, that that we're not going to grant them 20 and 30% return on their new equity money when we're only getting 5% interest rate on the loan. So that's kind of come together, and I see most borrowers who are interested in working something out on their new equity taking much lower yields and taking more of a chance on the back end.
Yeah, I describe for the commercial banks, we're entering round 2 versus 2.0. And I say round 2 because if you think about commercial banks, our average maturity is about 3 years. We originate loans from 1 to 5 years. And so most of those loans originated in 2007. We've already started dealing with a lot of the problems, started dealing with the problems in 2009 and 2010. So we've gone through a lot of the modifications. Some of it was just straight extensions. But now we're going through this next round. And what's different about this next round is that we have much greater transparency. We have data points. If you think about 2009, 2010, there was no leasing, there was no property sales. And in terms of valuation, that valuation was set by distressed assets. Now you're getting some better assets being sold. You're getting some leasing trends going on. And now you can assess the property and make a determination. Do you go forward with this client for this next round, or is it time to just sell the asset?
Right. Wayne, and start with you on this one. When you look at the workouts or restructures that you are planning to do in 2011 or you're currently working on now, how do those differ from, say, 2008 or 2009?
Going back to my last statement is now that we have a little more transparency to trends, we're no longer just going to push out an asset that has a high degree of leverage if there's not an upside to that asset. And that upside is really, for our side, is mitigating risk. And Chip said it earlier on the capital panel, is that the lenders, we're just paid our interest rate. There's no upside in terms of the value, but we have all the downside if the value drops. So if we have a sponsor that's actively managing the property and can show how they're going to improve the property, we'll hang on. If it's an asset that has not had any momentum for 3 years and it's going to hit some kind of leasing or some other events, it's going to create a cash flow impairment, we're going to react very quickly to take that asset or work with the sponsor to recapitalize with some outside entity.
Okay. Tom, Kevin?
No, I think for us, it's we're not doing anything really significantly different. I think that because of how the markets are going now, we're doing more sensible workouts now than we were able to do in 2009 and even early 2010, because the borrowers just really weren't there and they really hadn't figured out what they needed to do in order to work it out. So we're definitely seeing late 2010 and now into this year more agreeable workouts between us and the borrowers.
I think from our perspective, there's some better options available today because of things I said before in terms of liquidity. And 2009 and early 2010, investors would say to me, "Is that the best you can do in terms of a workout?" And I said, "Well, we took the best of the bad alternatives that were available in order to solve for the least worst outcome." Today, the difference is I think that you can take an asset, and it's very asset specific, and it varies from property to property and market to market. But To Wayne's point, if there's upside in that market and that property, and we think a thoughtful restructure makes sense to extend, to bring some fresh capital into that asset and give us a better chance of being taken out at a future date, we'll do that. But the other thing we look at, because of the term, especially in CMBS, where the costs of holding those assets because of the advancing mechanisms in the structure is very expensive, and our mandate as a special servicer is to maximize value to the trust, to the bondholders on a net present value basis. Note sales have become more prevalent, and partly because buyers of loans today are paying pretty close to what we think net asset value really is, without the delay and the litigation costs and some of the other things that factor into it. So I think the liquidity that's back in the market, the fact that people can leverage purchases at a little higher price than they could have a year ago, I think that gives you better options.
If I can just bounce off of Tom's statement, a difference in our borrowers over the last 90 days plus has been their mentality and the shift of that. In 2009, the statement was usually can't or won't.
Right.
And now with greater transparency, it doesn't only benefit us, but the borrowers. Now they're coming in fresh capital and saying, okay, now I see the upside for this asset. Let me come in and reposition it with you, put that equity in today, just give you more time to ride this cycle out a little bit further.
In your decision to work out a loan versus not work out a loan, what are the key things that kind of come to the top?
For me, it's cash flow.
Cash
Cash
flow.
flow right away. And it's cash flow not only to service the debt, but to handle any kind of tenant repositioning risk going forward on it.
Tom?
Well, for us, you got to bring something more to the table than your good looks. We're national companies, especially Kevin ourselves. We have contacts with every property manager, broker, asset manager that's out there. There's probably not a property that we can't manage as well or better than the borrower has been, with very, very few limited discussions. So in a workout, you better be bringing money. You better be bringing a plan that we all agree this makes some sense. And that's the start. That's the start of it. Just coming in and saying, reduce my interest rate and give me 3 more years, that doesn't do it.
Yeah, I think I agree with both Wayne and Tom on that. We, in 2008 or 9, the call would come in, borrower would say, you have a problem, and I would respond, no, we have a mortgage, you have a problem. And now what are we going to do about it? And today I think borrowers are realizing, and for us, the key to an issue, in addition to cash flow and the actual property and market metrics that you're looking at, is the borrower part of the solution, or did they create the problem in the first place? So you look at, asset-specific issues, market-specific issues, and borrower-specific. And, in the CMBS world, we had more than our share of, sort of our version of subprime borrowers. Borrowers that were buying, there was more of a trader mentality in 05, 6, and 7 when the greatest percentage of CMBS was issued. People were buying assets, leveraging them up, assuming that cap rates were going to continue to compress. And when they started to hit some rough patches along the way, they didn't have the expertise or the skills to manage through those problems from an operational perspective. Those are the kinds of borrowers that don't add value. On the other hand, people that are good operators, experienced, they have solutions, they're proactive, they're willing to commit capital, those are the people that we're willing to work with and try to restructure around the issues.
Now, all of you related to the fact that cash flow is one of the first things you look at. Where you've got a property where it does have the cash flow, but you really have a value issue. In other words, it's a maturity default, it's something along that line. How do you look at those deals?
I'll go ahead and take a stab. We're looking at the rents, and we're looking at the cap rates applied to those rents. And if we're looking at rents that are 30% off of the peak and a cap rate that's 200% or 200 basis points higher than the peak, we're going to look at the asset and say, what's going on in that market? Is it a good asset in a tough market today? And is there upside? Will there be trending of the rents? What does the supply look like? But if it's an asset that's just clearly over leveraged, that we went into it at a peak value and there's no upside in the rents, we'll take a different position.
Tom?
Our typical maturity defaults where the loan is still performing. but because of value constraints can't get refinanced, we're definitely looking at extending those loans. Now we want something for it. We want to get paid a fee, and we want to pay down a principal, and we're probably going to want to take all the cash flow and apply that to principal, so that hopefully within a year, 2 years, between some uptick in value and payment down on principals, that we can get paid off par on that loan. But we really don't see any upside to our bondholders to foreclose on a deal like that when you know you're going to take a loss. Number one, you're going to have a tough time getting it if it's cash flowing, and number two, why would you take the loss when you don't have to?
Yeah, I would agree with what Tom said. I mean, we look at things the same way. I mean, basically what you're trying to do, particularly in the situation with a maturity default and an contemplated extension, is you're trying to position that asset so that on its extended maturity date, you have a higher likelihood that you're going to be taken out. I think the only caveat I would say, you see certain issues with properties where there's specific event risk coming up, major tenant rollover, deferred maintenance, capital requirements, that sort of thing. Maybe the assets cash flowing today, but there's significant problems on the horizon. The one thing we will look at in that context is, am I simply postponing the inevitable by extending this loan today? Or am I possibly exacerbating the problem and increasing the potential realized loss, 2 years down the road? And so we weigh that against the value of going ahead and extending that loan.
Are there new workout opportunities that are still hitting your desk? Is the pace of these defaults increasing, decreasing? What's your expectation of this default velocity as we go forward? Kevin?
Well, I mean, what we've seen is a bit of a moderation on the CMBS side. I mean, you see the overall statistics, the numbers for the default rate inside CMBS and the number of assets at the special servicers continues to tick up. We've seen a bit of moderation in terms of the volume of assets transferring in. We've also seen a significant increase in the pace of resolution. So what we're seeing now at most of the special servicing shops in 2009, let's say, the ratio of incoming transfers to outgoing resolutions was probably 4 to 1. Today, it's probably getting closer to 1 to 1, 1.5 to 1, maybe 2 to 1 in some shops. And a lot of it depends too on the vintage of your portfolios. So I think it will still remain at a high level if you look at it in the historical context, but it will be at a much more moderate level when you compare it to second half of 2008 through second quarter of 2010.
Tom?
Yeah, we're still seeing a pretty good trickle into of new defaults into our shop. Certainly resolutions are picking up. I agree with Kevin. We're able to get more things done quicker there. Also the use of the various tools. We're using loan sales, DPOs, auctions, all that kind of stuff that gets stuff out of the house also. But I mean, if you think about it, if 10-year, again, we're a conduit shop, CMBS shop, so if you think about it, you look back at 2001, where the 10-year loans, 2011 are coming up again. It's like, well, did they retain enough value to get refinanced? So we're still seeing a lot of maturity defaults coming in, and almost anything that had a big tenant rollover risk, it seems to have gone the wrong way in CMBS land. So those are still hitting us.
Yeah, in terms of our side, we saw a big jump from 2007 to 2009. Just the U.S. Bank and commercial real estate, we saw our non-performing assets jump from about 140 million to 1.4 billion in a period of 2 years. And some of those were just valuation issues. They're still paying interest, but how we looked at it due to valuations. That had a big drop off since the third quarter of 2010. And we've trended down very, very quickly because any of the assets that had some leverage but was a good asset, those assets are being sold or recapitalized today. So just that sheer volume is going down. The assets that probably shouldn't have been built are in those marketplaces up in Northern California, like Sacramento. There's just very little opportunity for growth. You can't fill those buildings. Sooner or later, you have a tenant event. That tenant moves out. You can't recapitalize it. You can't pay leasing or TI costs. Those assets will continue to come back to the bank. But it's a fraction of what it was in 2009.
Right. Dan, add to what Wayne said, switching hats for a moment on the PNC Bank side. we saw sort of a similar story as U.S. Bank did in terms of the increase, but we've also seen a pretty significant decrease in the number of criticized assets, number of non-performing assets, and we're seeing a pretty significant reduction in the provisions for loan losses going forward and projecting out in 2011. So I think on the bank side, I think you will see continued declines on the distress side and moderation there. CMBS, not so much.
The last panelist talked about there is a big separation between the larger banks and I'll call the community banks. And it has a lot to do with the type of assets they finance and the locations of those assets. And they said before, $100 million asset, you have a lot of buyers. $1 million asset in Bakersfield, very few buyers right now. And in community banks, 45% of their loan portfolio is commercial real estate. And commercial real estate represents about 30% of their asset base on it. And they have very significant defaults occur in those community banks. The FDIC has taken a much more ginger approach with those community banks because they just can't go in and shut down those banks. There's 880 banks on the FDIC watch list today. And every Friday at 5 o'clock, just pull up FDIC site and you'll see 2 to 3 banks getting shut down one at a time.
On those new opportunities that are coming into your shop, the default opportunities, is there a specific property type or location that rises to the surface more than anything else?
Well, I mean, we're a pretty equal opportunity shop. Hotels have been particularly problematic for us. The pace of transfers in multifamily has moderated. There's a lot of liquidity in the multifamily marketplace, a lot of, from the agency side in particular, especially if it's reasonably good quality. There's also equity money that's chasing those deals. Retail has, I would take exception with our esteemed colleague that was on before who said we weren't 30% over retailed. I do agree with that. I think it's higher. I think we've seen a moderation in retail from where we were, say, early 10. What I think you are going to see is an increase on the office side because of the nature of the leases and the term of the leases. There's a bit of a lagging indicator there, and we're starting to see some distress in office. And the markets, it's secondary and tertiary markets where you're seeing the biggest issues and continuing to see a lot of problems, like in our portfolio in Nevada, Arizona, several markets in Florida. Those still seem to be the most troubled. It sort of correlates to the areas where you've seen the most significant drop in residential values.
Tom?
Certainly, I agree. It's regional. The Florida especially. I think we're still seeing a lot coming in Florida. Like Kevin said, we're equal opportunity, so we're getting everything in. Especially a lot of, one of the things that we see a lot of is the hotels coming off the older deals that, the flags came due in, the last couple of years and it went from a Holiday Inn to a no-tell motel. And, that was just the death of it because the guy wouldn't spend the money for the franchise and you didn't have enough control. We certainly see a lot of that happening, throughout the Southeast for the most part on that. But again, we see all types of property types still coming in.
Anything?
I'd say it would be opposite. We see a little more pressure on it, and that's just due to the rents and the turning of those rents. But for us, what we see is, and you hit on it earlier, Kevin, it's really market specific. So your CBD areas are definitely improving, coastal communities improving, but if you go to secondary and tertiary markets, there's just little improvement despite what kind of product type.
Right.
And if I can for just a moment, interestingly enough, we're just starting to see a few self-storage properties coming in. And typically, we had not seen a lot of self-storage in our special servicing shop for a long time. So it's interesting that we now have 3 or 4 of them within the last 3 months that have hit.
If I could have the slide. On this slide, I came across this at the craft conference we were at recently. And if you look at the 3 sections of it, the first section is the historical mortgage rates. And you can see that, in 2000, rates were, above 8. They trended down till, somewhere in 2006 where they kind of bottomed out, and then they started a slow rise back up, and today we're up probably 100 basis points from the bottom of the floor. The next slide is REIT NOIs, and you can see that from 2000 to 2007, NOIs rose. They crept up a little bit in 2008, and then kind of have leveled off since 2009. So from an NOI perspective, properties were increasing, but haven't decreased all that much. Then we look at the last part of that slide, and it really relates to values and or cap rates. And obviously, as we all know, the top of the mountain was 2007 when cap rates bottomed out, and then we had a dramatic increase in cap rates and decrease in values. I guess my question is, based upon the fact that as loans roll, as we look out to 2013, 2014, 2015, we have these huge amount of rollovers that are coming due. Is there an expectation that because interest rates are rising, cap rates are still down, are we going to have a huge amount, do you expect a huge amount of defaults to occur as we get out into 12, 13, 14, 15?
I'd say it's really dependent on what happens with supply and demand. And I don't see a lot of supply coming into market because you just can't build today at the rents in today's marketplace. And what's different about this recession, the commercial side versus the early 90s, we're not overbuilt. We had contraction, but we did not build excessive. So if we get jobs, we can create rent, and we start accelerating those rents. That will help offset any kind of interest rate. So we looked very carefully at that.
Tom?
Well, certainly if you look at the economy as a whole, and you look at look at our debt, something's going to happen there. It's got to happen there. We got to figure out how to reduce it. We're so reliant now on the rest of the world, and maybe people we aren't so friendly with, to buy that debt every month. If they decide not to buy that debt, that's a significant hit to interest rates in this country. Following that, just as important, and it's been mentioned probably in every panel here tonight, is jobs. And how did you create jobs? And so we're still sending more jobs overseas. And until we can reverse that, we got to figure out somehow how to start making things in this country again, instead of just buying them from overseas or getting a fee off doing something. We've got to start in this country having jobs that actually make something and create value.
Yeah, I think that's right. I mean, to Wayne's point, I think certain product types and markets, we're not overbuilt, we're just under demolished. And, I think you're going to see that. But one thing, if you just look at it, and I agree with all the macroeconomic issues and what happens with interest rates and deficits and things like that, and that obviously impacts, real estate and pricing. But if you think of it just in the context of CMBS, 65% of outstanding CMBS was issued in 2005, 6, and 7 at the very height of the market when underwriting was at its most aggressive. The vast majority of that was 10-year paper. It's going to start maturing in 15, 16, and 17. So, you could see a moderation, and then you could see another spike if the markets haven't improved and jobs haven't come back and rents haven't increased. So, I'm very concerned about that. We talk about bubbles all the time, but that's a bubble. It's still a ways out, but it's one that bears watching.
Unless they get into special servicing before that.
Well, that's true. That's true.
I mean, if you look at 2000, the stuff that a couple of deals that we won in 2007 are just bleeding really badly, and there's a lot of stuff coming into special servicing. That even stuff that we didn't think had a chance of being there. So,
in our active portfolio today on special servicing, I think I just did the stats for the end of February, 83% by balance of the loans in special servicing in our shop were issued in 05, 6, and 7. So.
A strategy in 2008 and 2009, maybe even in 2010, was kicking the can down the road. Are you still looking at that the same way? Are you still hoping that values will come back enough so that it can get refinanced when you're considering your decisions on working out a loan with someone?
I would say that that can is pretty well dented now, and it better get some fresh paint or it's going nowhere. And I say that in terms of the fresh paint really being a new strategy for the asset. If the asset's not moved in 2 years, 3 years, we're not going to do anything with it. We're going to give the borrower some time to sell the asset or find fresh capital. But I said it earlier, we're not going to ride another 2 years with high leverage and low debt service coverage-wise and hope things get better. We're just not paid for that.
Once again, I think I mentioned it before, is that any kind of quote-unquote kicking down the road comes with some pay down of principal and some 100% or of cash flow being collected to further pay down principal. So kind of in that context, I really don't see us when we do that as kicking a can down the road. Because basically, if we don't if we can't get any pay down and the property's underwater, we're just not extending it. We don't see any point moving on with it at that point. Let's get it back and get it out into the market.
Yeah, we're the same. I mean, what's it worth today? What can I liquidate the asset for? Whether it's selling the loan or foreclosing and selling the real estate. Unless I've got a higher probability of getting taken out of that asset on some future date, hopefully relatively short term, we're going to go ahead and we're going to execute on an alternate strategy and move on.
Fast forwarding to today, looking at the new CMBS 0.20 as it's being called, and I see a heavy concentration in retail. Are we creating a future problem for ourselves? Well,
the gentleman before said no, that we weren't over retailed and we had plenty of capacity, so I guess not. But my personal opinion, what you're seeing and it's, by the way, Dan, not to correct you, but it's not 0.2, it's 2.0, I think is what they're striving for here, although some people might debate that. What you're seeing in these new deals, there's been about 11 transactions since mid-2010 that have come to market or in the process of pricing, multi-borrower, traditional conduit type deals. The first few deals that were done were, north of 60% retail concentration. And a lot of that was because you had more institutional, borrowers, REITs, the like, that had typically had lower leverage on their properties anyway, and they sort of qualified, under the new underwriting standards. So that has come down somewhat to where in the last few deals, the ones that have gotten done now in 2011, the percentage of retail has dropped below 50%. On the other hand, the percentage of hotel is now starting to go up, so I'm not sure that was an equal trade-off in terms of quality. But the one thing that you don't see in the new conduit deals is you're not seeing hardly any multifamily product. The agencies have pretty much cornered the market for quality multifamily. So I'm concerned because what I see in retail in a lot of these properties, that have cash flow today, debt yields are good, loan to values on in-place NOI are reasonable, coverages are good, but you're making a 10-year bet on a cash flow that may or may not be sustainable over that period of time. And you see a lot of centers that have good tenancies today, but they're in markets that have sort of, and demographics that have moved away from them. And you see those tenant sales, even though overall retail sales are back to pre-recession levels, once again it's very asset specific. So the question is what happens with those properties and those tenants when their leases roll in 13, 14, 15, seeing a declining trend in their sales, and they don't renew or they renew at a significantly lower rate. And then you've got the impact of, you're going to continue to see the Borders of the world and the Linens and things, and the ripple effect that has, just really quickly, we had a center recently, we went back and we looked at the underwriting. It's in a portfolio with the name Special on. Borders is a tenant. That store is on their list of closures. The two other largest tenants in the center, One has the right to reduce their rent by half if Borders goes dark, and the other one has the right to go to percentage rent only. Well, you take Borders out of the equation through a bankruptcy lease rejection, you take the other two tenants at the reduced rent, you know, a 160 coverage becomes, you know, 0.9 pretty quickly, so.
We have been a very active looker. We have not bought anything in version 2.0 for one reason was we're not comfortable with the yields. We think they need to be higher. And the other thing is, especially in the deals in late 2010 and early 2011, we certainly feel that the quality of the assets, the loans and the underlying real estate is definitely going downhill. We're seeing, we bid a big number with big kickouts, and we were the cover bid. We almost won the deal on one of them. And they both had big malls in them. They both had that we wouldn't take. I mean, they were either in tertiary markets, and they were old and in significant need of a lot of TLC. And we all know what a mall in some of these tertiary markets can look like in 2 years. And the other deal was a poster child for that company that they've been giving back malls lately, and this is exactly what they have been giving back. And we already own a couple of them. We didn't want any more. So early on, I think I would have said that we were looking really good. The competition, we've added 20 conduit lenders out there. The competition is getting to it, and we're heading closer to, I think, the 2005, 2006 originations already.
Wayne, just a quick question for you, kind of our final question here. Obviously, a number of our borrowers are not going to make it through this time without going into default. Are you going to look at those as potential clients in the future, and what is it that you're going to look for them in if borrowers are looking for new deals that may have had problems in the past?
I guess the bigger question to the banks are bankruptcy used to be a no-no.
Yeah.
Discounted payoffs used to be a no-no. You don't finance it regardless if it's yours or somebody else's. And that's been accepted in terms of the community overall. You're going to look more so at the character, what happened in that transaction. Were they working with the institution? Was the workout or a DPO because of the other institution, or was it something forced by the borrower? So really we're looking at the character of the borrower and the situation itself.
Okay.
Yeah, Dan, we're the same way. I mean, we do a lot of diligence for our investor clients who look at new CMBS deals, and part of that is we do a pretty in-depth analysis of the borrower and their capabilities and their history. What have they done? Have they given properties back? Are there foreclosures? And we're not so much interested in the fact that there may have been problems, because people active in this market over a long period of time are inevitably going to have some problems. Question is, how did they handle those problems, and how did they behave with the lender? We've got borrowers that sort of fall into the life's too short category to deal with. The ones who jam you at every chance, take you into bankruptcy where they know there's not a confirmable plan, simply just postpone the inevitable, run up costs and increase your losses. And then you've got others that proactively come to you and say, here's my problem, here's my proposed solution. If that doesn't work, I'll cooperate with you in an orderly transition of that asset. Those are the kinds of people you're going to work with again in the future.
Okay. Well, I see that we're out of time, and I want to thank my panel for being here today and your candid remarks. If we could give our panel a nice round of applause, appreciate that.